we are officially live for the Tuesday edition of the Not Your Average Investor Show. Today, we are talking about the biggest housing shortage in a decade is happening right now. It's all over the news. I'm your host, Pablo Gonzalez. With me, as always, the man that I affectionately like to call GC because of his genius concepts he's going to be bringing up today.
Oh, watch out.
Because he knows how to generate cash flow off of those concepts because he's a great co-host and because his name is Gregg Cohen. So hello, Greg.
Hello, everybody.
And with us, as always, star of the POT dub last week, our phenomenal community manager. We call her MTM because she brings us the moments that matter and because her name is Madison the Magnificent. So hello, Madison.
Hi, everybody.
And if you are joining us right now live on YouTube, if you're listening on the podcast, if you are listening on YouTube later or watching on YouTube later, and you want to catch up to all the embedded knowledge that we have here in this community, we have a solution for you. If you go to notyouraverage.com, there is a how to invest in rental properties, the smart guide to investing in rental properties so that you can catch up to all the core concepts. I mean, you can go back and listen to all the shows too, right? Like
Could do that.
You're going to get it all and you're going to be entertained, but you're also going to be entertained if you go to the class, go to notyouraverage.com. It's about a 2-hour lesson. We took a lot of love baking it for you and serving it up on a platter. And because of that, we also want to give you a discount to check it out. GC, what's the discount code?
Get $500 off. Put in the code SAVE500. That's a discount that runs through July 4th.
Happy birthday, America.
Happy birthday, America. And happy birthday, America. And hope you enjoy it because this course is, like Pablo was saying, we've put all of the experience that our team has gained here being in this business for 17 years, managing over 5,600 homes now, selling over 3,000 turnkey properties, myself personally owning over 300 rental properties, and packaged it perfectly into this beautiful little class. And those 2 hours are broken down into videos that maybe 5-10 minutes you can listen on the go.
Minutes, yeah.
So I hope you would take advantage of it. It's a great way to get up to speed and be ready to rock and roll building your rental property portfolio.
It is a compounding asset. Knowledge is a compounding asset. You can take that knowledge and invest anywhere in the country, anywhere you know, and know that you're safe making the smart decisions on making sure that this thing is a passive investment for you and you're setting up to succeed long term. And the other thing that you get to do is that you get to be part of what you see.
The roll call, baby.
We got our leadoff hitter, as is tradition today, leading us off.
John Henning.
John Henning in the house. We got Milady.
Jack Chat.
Jack Chat.
All right.
Jack
Good to see you, Jack.
in the house. We got the ringmaster.
Andrew Barnhill.
We got Big Papa in the house. We love it when he calls in Big Papa.
What's up, Pops? Good to see you, buddy.
Greg.
Sorry I haven't returned your voicemail, Dad. I know you left me one earlier today, but at least I'm here with you right now.
Big Papa, I know how it feels to be abandoned by Greg for a golf trip. So just, we're here. Same. We got the early bird in the house from Columbus, Ohio.
Dean Curry.
Dean Curry. We got the karaoke witness.
Oh, Ms. Deborah Schwartz.
Deborah Schwartz. We got our favorite name to pronounce, Aaron O'Neill.
Into the light.
Aaron, good to have you back. We got the fairy godmother of the Not Your Average Investor Show community, fresh off a Northern California hosting a meetup.
Right.
Talked to her last night. We had like 15, 16 people.
No
up there.
way.
Yeah, man. Good
Fantastic.
time up there. Jen Filson, Monterey, California.
That's awesome.
We love it when the community gets together. We got our boy Louis Sudnell from our favorite place to mispronounce, which he may be moving from soon as well.
No.
So we got to really enjoy it when we say it.
Milpitas.
Pitas, California. Good to have you. We got the second family of the Not Your Average Investor Show community, our regulars, the Riley family, Gary and Rosalind from Murrieta, California. Our regards.
We regard you.
We got Raul Tirado is back. Raul, good to have you back in the house. We got the mountain man.
Billy Green.
Billy Green from the breezy mountains of Colorado in the house. Who else we got in here? We got Christopher Lee from Fernandina Beach.
Love that.
In
Good
the
to see you,
house.
Christopher.
We got the first family of the Not Your Average Investor Show. Ken and Carolyn Moline, matriarch and patriarch. Had a great time with JWB friends at BJ's in Cupertino last Sunday.
We salute you.
We got someone checking in from the text as Not Your Average Guest. If you check in from the text, then I don't know your name unless you put it in the chat or you change your name. So help us out, but good to have you in here saying hello, everybody. We got Laura Colby is back. Laura, good to have you.
All right,
back.
Laura. Good to see you.
From Washington. Good to have you here. Who else we got here? We got Denny Davis from Arkansas.
I can't do this. It's
silly.
I can't do it. I'm sorry.
We got our favorite fee-based fiduciary financial advisor in the house.
Kelly Barenbaum.
Kelly Barenbaum in the house. I sent Kelly a copy of Play Bigger. We're nerding out about category design these days.
I mean, we only give that to the people that we love the most.
It's so good. We got my hombre in the house, Renee De Hombre.
Very nice.
Renee, is that a new name?
No.
I feel like I would have said De Hombre in a fancy way
Great
before.
to see you, Renee.
Renee, good to have you in the house. Rebecca Staples, you name?
New name?
New name?
New name?
Rebecca.
Oh, new name. Great. Welcome to the party, Rebecca. So happy that you're here.
Good to have you here, Rebecca. And we got Eddie Harris from Atlanta in the house checking in as well. And Mary Rockoff rocking it in Arizona.
Love to see you.
Good to see you. GC, you sent me this text last week. I don't remember what we were going to talk about this week, but it got displaced.
It did. Do you know who? You know who sent me all these texts?
I believe it's Big Papa.
Big Papa.
Yeah.
My dad. He
Yeah.
sent me 5 or 6 articles.
Yeah.
And when Big Papa sends you 5 or 6 articles, you stop whatever you were doing and you change the show. Because I texted him as he was sending me articles about this housing shortage. It's something that we have known and have talked about here on the show. But when he sent me 5 or 6 articles, I said, Dad, are you searching for this information or is it just in your normal news channels? And he said, it's all over my normal news channels. And so when we get that type of feedback, whether it's from my dad or from any of you, we want to make sure we do a show highlighting that. And this is one that is super timely. It's super affecting our asset class. And the cool part is it reinforces a lot of the things that we talked about 6 months ago, a year ago, and 2 years ago on the show. And what do you know? They're coming to fruition.
Yeah, totally. So we talk a lot about on the show about data with perspective is the way to make decisions. And normally when you're getting served this data from the news standpoint, it's generally coming from a perspective of, I want you to click, I want to freak you out, I want you to read this thing, right? So first we're gonna inform you on what the data is out there, give you the perspective, let you know what it looks like from the insider's viewpoint, and then we're going to contrast it to what's going on across other asset classes and what's going on right now. So GC, this housing shortage, right, feels like something that you've essentially been saying for a while, but now it's making headlines. Why do you think that is? Can you give me a little bit of that?
Why is it making headlines right now? I don't even know, to be quite honest. I mean, I don't know how the media thinks.
Yeah.
And the reason that I say I don't know why it's happening right now to get this big push is because this has been a problem for America for a decade, right? The shortage of housing has been a problem for America for a decade. It is the number one reason why 6 months ago, a year ago, we said on this show that we did not see a housing crash happening, and it was because of the shortage of inventory. So why is everybody talking about it right now? I don't know. I mean, it's been here for a long time. It continues to be a worse and worse problem for America. But as a rental property investor, this is a good thing for you if you like housing prices having a high floor, if you like rent prices having a high floor and growth prospects in the future. Low supply actually works to your benefit for all of you who own rental properties.
Got it. And you say that you predicted this idea that housing wasn't going to crash 6 months ago, a year ago, when everybody started talking about looming recession. It sounds really familiar to exactly what you said in March 2020 of housing is not going to crash because of COVID, because of supply and demand, right? Because it takes a long time to catch up to this dearth of supply that we've needed that far, won't catch up to the demand of what's out there. So let's talk a little bit about the progression of like the numbers in the data. Give me a little bit of perspective.
Well, so let's start big picture and macro wise. So there's a great article that came out from Freddie Mac. Article actually came out back in 2021, but it talks about how did we land in this place of undersupply for the entire country. And so it did a bunch of research. Of course, it's Freddie Mac. They do a ton of research, and it's something that we can all know is incredibly credible. And what they said was that the housing stock is undersupplied by somewhere around 3.8 million homes, which it takes a long time to build 3.8 million homes just to get to a normal housing stock.
Yeah, it's a lot of cul-de-sacs.
And the problem is getting worse. So between 2018 and 2020, the housing stock deficit increased by 52%.
Okay.
So it got a lot worse. And that's before the pandemic, where it has gotten even more difficult to build houses because of supply chain issues and because of increased cost of materials and lack of labor. So this problem has been going on. And why has it been going on? Why is it so bad? Why did it get 52% worse from 2018 to 2020? Well, it's because for the decade before, we did not build enough houses post Great Recession. And specifically, if you had to target a type of home that we did not build enough, it was entry level homes. What do we invest in here?
We invest in workforce, blue collar, entry level homes.
And why do we do that? It's not just for the growth, it's for the what mitigation?
The risk mitigation.
Risk mitigation, right? We talk about why we focus on workforce housing. It's because it has been and will continue to be for a while now the most underserved housing market. There simply is not enough homes being built, and this is not a new thing, right? It's been going on for more than a decade. So that's where we have landed here. And when the data comes out from Freddie Mac, I know it's going to be even worse as far as the number of entry level homes that are being built now. It's just simply not keeping up with supply, with demand. Sorry.
So 2018 to 2020, you said that deficit increased by like 52%, right? The deficit increases by 52%, leading to this like lack of, glaring lack of supply. 2020, supply chain affects everything. I would say supply in materials, which we're all really aware of, and a little bit lesser aware of, we may kind of like rant about it, but also in labor, right? Like the amount of like labor available to the home building industry seems to have been disrupted by a bunch of different things, right? Like some call it generational, that young kids just don't want to work. I have a more positive view of it, that it's just like, hey, in the world of the internet, where I can just get a job that I can make $1,000 or $2,000 a month on the internet, then I'm probably not going to go put tar on. It's
hard to build houses.
It's hard. It's really hard to do. And a whole bunch of other social political things, right? So that continues to happen. What is the data telling you right now, JC? You want to give us a little bit of a breakdown about that stuff?
In what regard specifically? I got a lot of data I can share with you.
I know you do. I would like for you to, I guess the most important thing is, how do I reconcile this idea that there is a housing shortage with the idea that the media keeps saying that there has been a decrease in home sales?
Yeah, that's a good point, right? The media has been talking about this crash that they expected for a long, long time. And the first thing that they talked about as why they felt that there was going to be a crash was the percentage of home sales decrease, the number of home sales that we have this year versus last year. But home sales decreasing does not mean that home prices have decreased, which is a very big thing, right? When we're talking about a crash in the stock market, we're not talking about the number of trades that happen and how the number of trades go down. We're talking about if prices would crash. Well, in real estate, for some reason over the last 6 months or a year, right, the media has talked a lot about how the number of home sales have gone down. But home prices in many markets, Jacksonville being one of them, have not gone down. There are some markets across the country where home prices have gone down, but it's not across the board. In Jacksonville, home prices have actually gone up. So we have to separate home sales from home prices and understand that if there was a crash, you know what the crash was? It was a supply crash. And it happened many, many years ago, and it continues to get worse.
So then reduced overall number of sales doesn't necessarily correlate with prices going down. It just correlates with reduced activity happening in the market. But behind the scenes, there is a imbalance between the amount of people that want to buy a home and the amount of homes available.
Yes.
You want to give us a little bit of behind, one of the things that I found really fascinating is the idea that while existing home sales are down 3.4%, that new home sales have increased. Do you want to give us a little bit of insight behind that data?
Well, let's all understand now that home prices are normalizing, which is exactly what we came out and said 6 months ago when we were the oddballs. And we said that the home pricing is normalizing. It is not going down in a place like Jacksonville. So you ask, why is that happening? Well, the number one reason was inventory. We looked and we had a lot less inventory available to meet the demand, even as the demand was coming down because of high interest rates. We still didn't have enough inventory. So that's the number one reason. But the next reason goes to the breakdown of the type of sales that are happening. And there is one segment of sales that is much more price resilient than another segment of sales. Okay. So I'm going to hit you with some data here. overall home sales have gone down, but existing home sales have gone down a lot. New construction home sales have actually increased year over year. I said that again, new construction home sales have actually gone up from last year. Most people do not understand this. So this is from, again, Freddie Mac. In April, existing home sales were down 3.4% from the year before. New construction home sales were up 4.1% from the year before. And this is from this year. This is from June 2023 now I'm talking about. For the year, January to April, existing home sales are down 14%, but new construction home sales are actually up 2%. So what's happening now is the composition of the marketplace is changing. New construction, while it is not enough to satisfy the big shortage that we have, new construction is happening and it is filling the gap because there's just not enough existing homes on the marketplace.
Why wouldn't there be, if prices are going up because there's a lack of supply, why wouldn't people be selling their home and cashing out in a way to be like, it sounds like a seller's market.
Yeah.
Right?
Yeah, this is a big thing. So, you've heard of like golden handcuffs, right? You've got a job.
Kelly mentioned them in the chat a second ago.
Oh, really? There we go. That's why we think like we have such a great community here. Yeah. You've got golden handcuffs. You've got a job that you just can't leave, even though maybe you want to. Well, we've kind of got something like that happening for all of us out there who have mortgages that we obtained in the last, 2-3 years, right? According to Goldman Sachs, 99% of mortgages right now are under 6% interest rates.
99%.
Yeah, 99% are under 6%. And there's a large percentage of those interest rates that are under 3% and under 4%. I think it was 72% are under 4% or something like that of those mortgages. So if you are sitting in a home and you've got a 4% mortgage, and oh, by the way, you probably bought that house recently because there are a lot of home sales that happened over the last few years. It is not going to be easy for you to leave that mortgage and that home and go and buy something else, because for you to go and make that decision to go and buy something else, your payment, even though your payment largely is going to go up significantly, and you're going to get a lot less house for it. Yeah. And so people are just flat out not doing that. And it's the rate lock effect. People are locked into such low rates. And that's why we have a lot less listings that are coming on the market right now. We have on listings is the same thing as inventory, so you already had a shortage in housing that was developed because of the underbuilding from the Great Recession. You had this from 2018 to 2020, even before the pandemic, where we still were increasing our deficit. Now you've got the rate lock effect. And this is the biggest reason why supply is not going up. This is the biggest reason why your floor for pricing continues to remain high. Because even though the Fed is doing its best to decrease demand by increasing interest rates, there is still such low supply out there that it keeps home prices high and stable, which is what we've been talking about for a long time.
Got it. So then why is new construction?
Oh yeah, let me connect those dots there. Yeah. So go back to that new construction and existing construction thing. It's not homogeneous now, right? There's a lot more new construction on the marketplace versus what there was. In fact, I have a stat for that too. About 30%. So available listings now, about 30% are new construction. That's the highest on record since 1999. And just to put it in perspective, it was about 7.5% of the marketplace was new construction back in 2011. So you're at about 30% of the market. Now, the reason this matters is because home builders have this special ability to be able to buy down interest rates for their buyers that you, me, you all out there, homeowners who are just selling their existing inventory, we do not have those same abilities. There are regulations in place that we have to abide by because we don't own our own mortgage companies, to where there's a limit to the amount that we could buy down the rate for a buyer who wanted to buy our properties, right? I'm thinking for like regular homeowners, not JWB. JWB actually has the ability to buy down your rate significantly, but let's just talk normal homeowners out there. So for existing inventory, there's less of it. And if you needed to take a decrease in price, you would have to take a decrease in price. You couldn't just buy down the rate low enough to attract buyers. New construction does not play by that set of rules. Builders own their own mortgage companies. And what they're doing is they are buying down rates tremendously. They may spend 15 grand to buy down the rate on that mortgage for that buyer who's going to be buying that new construction home. But what do they get to do with their price? They get to keep their price high. The sales price remains high. It is not going to affect sales price. And this makes a lot of sense for them to do, because while they may, lose, call it a net of 5 grand or 10 grand from buying down the rate, they're going to make that up by their sales prices continuing to remain high. Because if they were to drop the sales price for this unit and this unit, that would affect every other unit they sell in that community. So there's nothing wrong or there's nothing illegal about this. It just makes financial sense. But when your overall composition of housing is much higher on the new construction side, what that does, it creates even more of a high floor for housing prices overall, because builders have the ability to give incentives that regular homeowners do not, and their percentage of sales in the overall marketplace is a lot higher.
Okay.
Does that make sense?
Yeah.
Okay.
It makes sense. It makes sense that the builder that is bringing a new product to market is operating at a different scale than the homeowner that is selling their existing home. And therefore there is not different rules, but just different levers to pull on the rules of the system, right? Because of the scale that they're operating at. I guess my biggest takeaway from right now, GC, and let me know if you'd add anything to at least this section of the show. We talk a lot about data without perspective, needing the perspective to have the data. And we also, for the last year or so, we hear a lot from our community, recession's coming. What if there's a decrease in home prices? Maybe it's not the right time to buy real estate right now because of all these different things that are happening. And while we see the rest of the stock market and all these other things kind of like taking different kinds of tumbles, it feels like housing, as we see it, you need to look deeper inside of whatever these absolute numbers that the average kind of like media source puts in front of you, or the average kind of headline that you read, because housing has so many different twists and turns and levers that make it more resilient than you think. So diving deeper into the data and getting the perspective of, okay, there's a housing shortage. Before that, prices were going down, but within the prices, not prices going down, I'm sorry, sales were going down. And within sales going down, it actually doesn't make the price go down. It actually exaggerates the shortage to a certain extent. And because of the different dynamics of builders versus existing homes and people in mortgages that want to keep these mortgages versus move and like cash out in this buyer's market, it just continues to add to this high floor of home prices, rent prices, and all the different things that we preach that have to do with risk mitigation in this asset class.
Absolutely. Right. It's like, what more can you throw at this asset class and still it proves to be resilient?
Yeah.
Right. We had the pandemic, we had moratorium on foreclosures for a while, and everybody said at first, because there was a pandemic and, housing was going to collapse. And then there was this eviction and foreclosure moratorium, and everybody said, well, the rental market is going to collapse. How can you collect rent when the threat of eviction is not there? That, of course, did not happen. We collected over 98% of rents all through COVID. Right. And many others did very well in our space as well. They said that there was a foreclosure moratorium and that people, because we were going through the pandemic, were not going to pay their mortgages because there was a foreclosure epidemic, or because there was a foreclosure moratorium, and that there would be this wave of foreclosures afterwards. And then there'd be a crash. Have you heard anything about that recently?
No.
All that noise for nothing. Right? Never happened. Right? For the last 6 months, people have just been saying, wow, home sales have gone down. This must mean a crash. This is a great time for us now, because finally the media is coming around and realizing that there is a shortage, and that I'm finally reading articles right now that are saying there is no crash that's happening. Finally it's coming around. But at the core of this, the reason you're investing in this rather than some paper asset or in Bitcoin or something crazy is because of the utility it provides. The reason that this is so consistent is because the utility that it provides. And people understand the utility it provides as well. It's a roof over your head.
Yeah.
You know, so I feel like this is a moment now where like this negativity of crash is starting. It's starting to be in the rearview mirror, right? Year over year, home prices are actually up in many parts of the country, and all the articles are saying, I didn't expect that. Everybody else who's not a part of this Not Your Average Investor community might be saying that. We talked about that. So I finally feel like this data with perspective wins again, and other people are finally starting to see it. And it just comes from doing this for 17 years and having your own money on the line for 17 years and managing 5,600 homes for other investors here. Like that is why we are able to give you this data with perspective, because of the responsibility we have.
I love that, man. And I love how every time this kind of happens, right? This is like the third time that we are able to be like, yep, we got receipts of like 6 months to a year ago being contradictory of like what the headlines are saying, right? It was the COVID stuff. It was hey, they're about to tell you the housing is going to crash. Like at this exact moment, you predicted that. Now you've been saying, hey, even though they're saying that, that's not what's happening because of this, right? So like, I like that this builds up your gumption to like rely on this thing, go out and give, you're a very cautious communicator. And I like when you get out there and you're just like, no, man, this is what I'm seeing and I believe in it. And like, I'm going to talk about it, right?
Yeah.
So like, I like that this gives you license to speak. The other thing that I think is important to talk about is that not all real estate is built the same, right? Like we are specific talking about this idea of workforce housing, blue collar housing, entry-level homes. Howard Scarrett's got a question that says, what do you consider workforce housing? Do you qualify by price point, location? What asset class are we talking about specifically here when you're talking about this housing stock?
And there are specific qualifications. It's based on adjusted median income for a certain area. And I forget what the actual percentage is. You can just do a quick Google and you'll find what the percentage is. But basically it's an area that's below middle income, not low income. That is not workforce housing, but below middle income, right below the middle income, median income line is that type of a neighborhood that we want to focus on, where there's low home prices, high rent demand, and surrounded by jobs. Those are our types of neighborhoods.
Yeah. And specifically, the reason why we think that this has more risk mitigation, as this data is proven, right? Like it's this idea that at that price point, below the median income and being able to get in there, you have a base of people that this is what they can afford. And this is the best place that they can put their kids in order to have like space and go to, and be able to go to school and whatever. Right.
Mm-hmm.
And then there's also the next level up, which is the people that live at the median / above median income that have priced themselves out. Like they now afford a better quality of life. When they hit hard times, they recede to this below middle income kind of like housing stock, right? So it has like this like built-in base that's always going to want it because it's a necessity for them. And then it has another built-in base of like, this is my backup plan before I hit really, really hard times, if I hit some hard times, which makes it a very, very attractive recession-proof investment, right?
Yeah. And if you want some easy ways, this is not foolproof, right? This is just an easy general way to find workforce housing in your area. You can understand what your median sales price is in your area, and then just go, if that's the 50% metric, go 25% median sales price to 50%. You're probably looking at workforce housing type neighborhoods there. I wanted to add one more point too. It's not just risk mitigated because of those factors, which it is for those factors, but think about how this relates to what we just talked about with Freddie Mac. The severe underbuilding in those areas. This is also the area that's been least served from building as well. And while that is not a good thing for our country, when I think about where I want to put my money and to be opportunistic, I want to put my money in a place that is not being served well right now, so that we can serve that place and that you can earn better returns that place. And that's why we love investing in workforce housing. I do not invest in high priced homes. It's not because I can't afford it. It's because I love workforce housing.
Yeah, I like that. That adds to the risk mitigation. It also adds to what you're saying, the utility, right? Like if there's a lack of it, you might as well be providing it.
Right. That's what we are here
Because
to do.
people need
We're here to be a part of the solution for
Yeah.
it. And
Yeah.
everyone who invests in workforce housing, you're a part of that solution too.
Got it, GC. So now that is the data with perspective on the macro level. Talk to me about Jacksonville.
Yeah, so we haven't done the market update in a while, but I thought it'd be great to give you some nuggets of how the market's performing here. So let me just check out the stats here. So as of May, Jacksonville's median home sales price is $355,000. Well, 1 year ago, the home sales price was $354,000. So as we have been talking about how this market was stabilizing, even as the media is saying it was crashing, here's real data. $355,000 price point year over year is the right way to look at home price appreciation. It's normalizing. That's kind of what we're expecting. And it's been that way largely for each month. If you look year over year rather than month to month to month, that's the problem. People don't take seasonality into account. And we've done many a show on that.
Yep.
Then, so from an inventory perspective, we have 6,377 houses on the market here in Jacksonville as of June 1st. We had 2,943 sales in May for a months of inventory of 2.17. Now, if that's a lot of numbers for you guys, you're not really sure about what months of inventory means. That is a great leading indicator for pricing. When you have an MOI or months of inventory below 6, that would lead to higher than normal home price appreciation over the next 6 to 12 months. So an MOI of 2 is incredibly low. Like that is an indication that if the Fed did not jack up interest rates as high as it has, think about what home prices would be doing right now.
Going nuts.
They would be a lot higher. There would be significant growth.
Yeah.
I did a little fact checking or a little perspective checking, I guess, because what happened in 2020 from June of 2020 to June of 2021? Did home prices go up? Yeah, home prices went up 17.6% in Jacksonville from June of 2020 to June of 2021. Number of houses on the market. Remember, we had about 6,400 here in Jacksonville today. June of 2020, we had 8,000 houses on the market. So inventory has gone way down, just like we've been talking about on this show. Sales were only 2,300 sales. We had 2,900 just this May. We only had 2,300. Yep. Our MOI was 3.46 in June of 2020. So absent of the Fed's QT, quantitative tightening, and policy of raising interest rates, this is showing you that home price appreciation actually would be a lot higher than what it is, and should help everybody answer that question that you have if you're sitting on the sidelines. Like, this data should matter to you, right? This is why when we talk about, when was the best time to buy real estate? It was 10 years ago, because this thing performs so well over time. But when's the second best time to buy real estate? It's today, because home prices, no matter what happens for pricing over the next 6 to 12 months, honestly, it doesn't really matter. It doesn't factor for me because I'm a buy and hold investor, and you should be too. But no matter what pricing does in the short run, home prices are going to be higher in 3 years. They're going to be higher in 5 years. And if you see a need in your own portfolio to diversify out of stocks and bonds, or to diversify out of another real estate market and move into a growth market like Jacksonville, like, now is a great time to do it.
Yeah, you say now is a great time to do it based on these statistics of shortage is still there. People are still moving here from places, right? Like, we get the anecdotal data all the time. Still one of the fastest growing metros in the US. Workforce housing and this asset class that we talk about, while there is generally a dearth of it in the US, I find that in growing markets that gets exaggerated, right? Because everybody's trying to, this immigration is probably coming from places of higher wages, right? Like, people are coming from California, people are coming from New York, people are moving up from Miami, and people are coming here with a whole bunch of money. And what's being built, for them is this like higher class home stuff. But all those folks require services. They require the blue collar workforce in order to satisfy the needs of what is coming to the city. And there isn't enough of that going up. Then you multiply that, right? So like that is the data that we have right now. MOI is really low, right? So there's a shortage of inventory. You multiply that by this growing trend of a population, and then you add on top of it the idea that what we talked about last week, right? This Jacksonville downtown is really, really coming online. We know the data around cities. When the urban area reaches a certain critical mass, the curve bends and the home price appreciation starts going way up there. And what we want to do is get in front of that, right? Like once that starts happening, you're going to start thinking, you know, if you're thinking, man, $250,000 for a house that 10 years ago was $80,000, I don't know if I can do that. You're going to start saying $500,000 for a house that 3 years ago was $250,000.
I know.
So that's going to get even a harder equation, or you can just get in front of it right now, right? Like Jen Filson was just put it in the chat a second ago, this idea of like downtown Jack's growing and all our properties going down. It's like, you know, she compared it to investing in San Jose before Silicon Valley became a thing, right? And then Ken Milleen backed it up saying he bought his house in 1975 for $36K.
Wow.
And 2 years later for $66K, right? Like this idea of these black swan events that happen once in a generation inside of a city. So you take the macro data, dearth in workforce housing, in homes for starter homes and for the blue collar class. You take the local data of locally here, there's an exaggerated need for this because of the changing dynamics, the growing population, and the months of inventory tell you it. And then you look in the immediate future of what's coming, of this like explosion of downtown and what's about to happen. I mean, it seems to be that you talk about risk mitigation in an asset class, you talk about risk mitigation within the asset class, and then you talk about risk mitigation in a market for the asset class specific. It seems like a really nice cocktail.
There is an urgency. There's an urgency to take advantage and hitch your wagon to a growing downtown. If you know anybody in Nashville, or you know anybody in Tampa, or you know anybody in Austin, ask them how much more they would love to buy workforce housing around downtown.
Yeah.
Ask them if they'd like to go back in time and do that 10 years ago.
Yeah.
You already know the answer is I would have bought as much as I possibly could, right? There's a reason that over the last 10 years, those three cities, I just did the data on it, those three cities have appreciated 23% more than the US overall, those three cities. A lot of that is because of downtown.
Because of an urban center that has been activated.
Yep.
Yep.
And you look at the data for Jacksonville, and you can't always see it because that's how these things work. You used to go to downtown Jacksonville, and certainly looks nice in some places, but there's still some vacant buildings. But what's going on from what you don't see is over $4 billion in construction going on right now, the most we have ever had in our city. Washington, D.C. has $1 billion going on, and that's the nation's capital. I read their state of downtown report. It had $1 billion, and they talked about it like it was a lot. Jacksonville, little old Jacksonville, has over $4 billion. That's up 450% from 5 years ago. There's so much going on, and this creates this urgency where those who take action, those who invest in rental properties right now, because of the urgency that Jacksonville's downtown provides, as well as the risk mitigation that this asset class and JWB provides, are not just going to do really well with their money, but they're going to do well with their money compared to what others are doing. Others are going to lose money in other asset classes, and potentially as we may go into a recession.
Yeah.
Right. So I think this is a special time. Yeah. Just like 2 years ago was a special time to invest, this is a special time for a different reason.
It really reminds me of the old adage of like, be greedy when people are fearful and fearful when people are greedy. Right. Like it feels like 2 years ago, right as COVID hit, everybody was really, really fearful.
Right.
Became a wonderful time. Right now is this like recession and all these interest rates and all this stuff. Everybody's so afraid of real estate. Feels like a good time to be greedy again, particularly in Jacksonville. If you want to have that conversation, the best place to go is chatwithjwb.com. Ask, like those first calls are really get to know you, understand, get to know the nuances of what you're looking for. And does this really, really fit as far as like, is it for you right now or not? Right. So like, obviously a good experience in a background, in a vacuum because of all these things that are happening. But if you have things that you want to just kind of like talk through, go to chatwithjwb.com. What you were saying about all this other building makes me think of Bob Wiesner. Bob, good to see you, man.
Hey, Bob.
In the chat, he says, in Jack specifically, are you seeing new construction other than JWB in the more expensive and not workforce housing? So you just mentioned all these like construction numbers. Can you give us a little bit about like what construction is going on outside of just workforce housing and JWB?
Are we asking about how much it costs to build a house outside of JWB, or
No, I think he's just saying, what is the state of construction overall in Jacksonville?
Yeah, lots of construction, lots of single family construction compared to where it was years ago, and lots of multifamily constructions. More on a percentage basis, there's a tremendous amount of multifamily construction going on, as well as commercial construction, especially downtown. So it's an interesting thing where we are seeing increased level of construction on all three of those asset classes that I talked about. But the single family one is the one that's most underserved, the one that's the biggest shortage. And so therefore that represents the biggest opportunity.
Any insight into like luxury single family versus workforce single family in those numbers, or is that you're not that granular on it?
I haven't looked at it.
Okay. Cool.
Yeah, I don't know.
And then Jag asks, are all your properties for sale currently around downtown?
Yes, absolutely. We chose these neighborhoods for a reason. We wanted to be around major job centers. I can't tell you that 17 years ago when we started to invest that I knew that downtown Jacksonville was going to explode like I expect it to right now. But we chose these neighborhoods, these 4 major neighborhoods, because they were around major job centers. Even before downtown continues to revitalize, we have the greatest concentration of jobs there. We have over 55,000 jobs in downtown Jacksonville. So yeah, our 4 major neighborhoods haven't changed, even though we are able to hitch our wagon to downtown's growth. And so we're going to put you in one of those 4 neighborhoods. They're all very similar in nature. I wouldn't pick one over another. You just want to be surrounded by jobs and surrounded by a growth agent, which is what downtown is.
Yeah, and it's interesting because you look at the population distribution of your neighborhoods, and it's, downtown's the whole of the donut.
Mm-hmm.
But what's interesting is that before, when y'all started 17 years ago, some of them were directly tied to the jobs in downtown, but they're also around other job centers.
True,
right?
it's not the only one.
So Northside has the logistics kind of like hub of the city, which is the airport and the cruise.
Jacksport,
and the Amazon distribution center. The West Side has the naval base and other Amazon distribution centers. And then you have the ones that are like Arlington and Southside that is also downtown, and the medical sector. But all of it is being fed into, like, it's all around a 15-minute drive of downtown as well, which is
absolutely
cool. All right, GC. So we've talked about now macroeconomics of the data and what's happening in housing right now, the supply shortage. We talked about the local economic sector and how Jacksonville's numbers themselves seem extraordinarily strong as well. Let's talk about real estate to real estate, right? Well, at the same time as we're getting these headlines on lack of housing in downtown, we're also getting headlines of a looming commercial debt crisis. Can you explain that a little bit?
Yeah, and I think it's going to be confusing because when people hear real estate crisis or crash, everybody thinks all housing prices are going down, especially if you hear home sales are down. And that must mean, commercial has got problems and commercial office space does have problems. Does that mean that single families are going down? And so I wanted to kind of clear through some of that noise and tell you what to focus on, right? Syndications, depending on the type of syndication, may have some problems here. So I wanted to share some information with you all. This is from the Wall Street Journal. From 2020 to 2022, syndicators raised at least $115 billion, according to the SEC. So that was the age of easy money, right? And easy money affects real estate more than other sectors. And so whether you're an experienced or a novice syndicator, a syndicator is somebody who raises money from other individuals to go and take down is a term I use, but to go and buy and redevelop a big property or a shopping mall or a strip center or something like that. That's generally a syndication. So syndicators, because it was the age of easy money and the numbers could pencil out really well, they went and they raised money as much as they could, over $115 billion. But the problem is with rising interest rates right now, these entrepreneurs, and I'll share with you, many of them are not experienced at all. The numbers do not work now. The financial pressure is there and they can no longer afford the payments on a lot of these properties. And we haven't seen a wave of foreclosures on this yet, but I expect that we will. And the reason why this syndicator might have pressures, whereas you as a JWB investor does not have those same pressures, or I don't have those same pressures with the 300 properties that I own, it comes down to the debt. We talk a lot about how much I love smart debt and single family rental properties. Well, it's not the same for commercial. Commercial properties have different debt structures. Okay.
Okay.
It's a little bit more like the wild, wild west. In single family, your debt is largely locked in for 30 years with a fixed rate with no prepayment penalty. Well, in the commercial world, your debt is not that way. Many times, your debt has to be paid back in a very short amount of time, or it adjusts in a very short amount of time. Think about 5 years is pretty typical. Or it could just be called due. It could be a balloon payment due in 5 years, or it could just adjust. And so with so much money raised over the last 5 years, and some of these commercial products are less than 5 years, by the way, as far as when the debt is due, with so much being raised over the last 5 years, those loans are coming due. Now, typically, if you look at the model for syndicators, they would model it out and say, okay, well, when the loan is due in 3 years, or the loan is due in 5 years, or when it adjusts to something that I don't want to hold on to, I'll just refinance. But the problem is a lot of these syndicators' assets, which are commercial assets, not single family, commercial assets have taken a beating, many of them.
Yep.
So now when they go to refinance, there's not equity in the asset. So they can't just refinance, even if they wanted to, right? There's not equity in the deal, and they certainly don't have the cash to be able to bring it to the table to refinance. Even if they could, would they want to? Because interest rates are way higher now, and it doesn't pencil. And, and also commercial lending is a little bit tighter now post Silicon Valley Bank and Signature Bank closings. So it's a triple whammy for these entrepreneurs, many inexperienced syndicators out there who raised over $115 billion. So something to keep an eye on. I do expect that there will be a lot of heartache for a lot of those who have run syndications recently and those who invested in them.
So if I'm hearing you correctly, GC, this syndication, and just based on life experience, syndication to me seems like, I don't know if this is accurate, but it almost feels like one of the things that when you get into real estate that people gravitate towards them because they're able to, you have a good network, you've maybe been a part of a couple of deals. It seems like a relatively easy model to replicate versus other models of replication. And because the going's been so good over the last 10 years in real estate, that has led to a bunch of people moving into this space, right? So what you're saying, there's been this like big growth in offerings of syndications.
Yep.
And you couple that with the market changed, right? The asset class has been valued differently because COVID disrupted the value of office space. The debt structure that they're used to having has also been turned around when the Fed decided to raise interest rates. And this is a asset, or at least an investment, that's pitched as a short-term investment. So therefore, short to medium-term investment. So therefore, you put those three things together,
right? A
whole bunch of new people in the game, a changing market dynamic on a macro level, and the changing debt structure lever that is a huge, huge part of the game. It means that there's going to be a bunch of them that are going to suffer. So I hear that. That makes sense that there's going to be a lot of suffering. Serge Bourbose also says bad syndicators with bad underwriting are in trouble. Good syndicators will be fine. I don't think that what you're saying is in a position to that. There's still good syndicators that have been doing it for 17 years, like you guys have, that is doing. I think what we're saying is that there's going to be a higher incidence that you run into like a not as good a syndicator as you do a good syndicator. And therefore you got to be really careful because this stuff has really changed. Whereas in the single family home market, even the person that didn't see all of the outs right now, because all this stuff has happened, the asset is still looking good. The fundamental asset is still looking good. So even if you're more of a rookie, chances are that you're not going to get completely screwed over. Whereas the inexperienced one in the syndicator game is going to change real quick for them real fast.
Absolutely. And I invest in syndication. So I certainly believe in that asset class. But, we talk a lot about on this show how to make your decision to invest in a single family rental property. And so many people get it twisted. They spend so much time analyzing the property and they don't spend any time doing their due diligence on the team supporting it. Well, that's a mistake. And it's really a mistake in syndications, right? In syndications, for some reason, it makes a lot more sense for people to, I guess, just to go based on what a syndicator says. You just get fed a whole bunch of paperwork and, you're just like, okay, cool. I'm just going to sign off on it. If you don't actually know that syndicator, if you haven't done an investment with them, seen how they perform for 17 years, like their models don't mean a whole lot. So whether it's single family, whether it's syndications, invest based on the team first and foremost, always. And if you do a good job with that, largely they are going to choose a market that's successful. And then beyond that, the property is just a widget.
Yeah.
Right. So Serge, I'm assuming where Serge invests in his syndications, and those are wonderful syndications by and large, right? Like those have such a strong team supporting that asset. That's the takeaway here. There's a lot of people, when I see 115 billion raised, there's a lot of people that invest with people not like Serge and not like me and others who focus on the team.
So top takeaway, which is also the main lesson in the notyouraverage.com, is this idea that people fall in love with the actual asset. Then they spend all this time looking for this like one asset, one thing to buy.
Yeah.
Right. Then they're like, oh, okay, cool. And they probably just assumed a market out of proximity or something else. And then they spend like 15 to 20 minutes to an hour on the internet, on Craigslist, pricing out 3 property managers, 3 operators to see what happens. We believe that is wrong, right? The way that you invest in real estate is, especially long-term when it comes to operating, find the team first, right? Like find the team that aligns with your goals, is going to provide you the best experience possible, because real estate is a game of endurance. So the better the experience, the longer you're going to be, the better that you're going to do. And then from there, where the best teams are, then you look at, does the market make sense for me? And then once you have the team and the market that makes sense for you, that team in that market should be able to just give you a widget that you can invest in, right? So that is fundamental to the understanding of this. Beyond that, when it comes to syndications versus rental properties, the underlying asset is at risk in syndications based on like not just the operator risk and not just like that piece of like making it work and making the experience good. The underlying asset and the mechanics of it have changed drastically in the last couple of years for something that you're looking at like a 2 to 7 year term. Whereas inside workforce housing, single family homes, the underlying asset and mechanics of it, Still strong.
And let me point out the differences between a JWB investment and a syndication. A syndication is where you invest with a whole lot of individuals and you own a share of that company that owns the asset. And then when that asset sells, that syndicator makes money by managing your asset all the way through to completion. And they take a percentage of your profits when you sell as well. That's not what you do when you invest in a regular old single family rental property portfolio with a turnkey provider like JWB, right? Number one, we sell you the entire asset. You own that asset. You secondarily hire us as the property management company, but you have full control, which is really important. That's the biggest difference between investing in turnkey properties and a syndication. You have control. You also own all of the upside. A syndicator is going to take a piece of the upside when you sell. As a turnkey client, you own the entire upside. Clients get fixed rate loans on single family rental properties, 30-year rates, no prepayments, the best rates that you can possibly find because it's a typical Fannie and Freddie backed mortgages. It's kind of the wild, wild west when it comes to commercial mortgages. So big difference there. And here's another key takeaway. We haven't talked a lot about this, and maybe this will come up in the future, but there's a lot less interest rate risk when it comes to single family turnkey rental properties than when it comes to commercial assets. And this is based on the way that single family homes are valued. Single family homes are valued based on comparable sales. So whatever somebody paid down the street for you is going to affect your value of your home. Whereas commercial assets are based on an income approach. And if the interest rates go way up and the income goes way down, then there's going to be a lot less demand for that commercial asset. But on the single family side, even as interest rates have gone up, like we've seen throughout this show, home sales continue to happen because people need a place to live, and they're going to continue to buy a home and pay full market value for it. So there's a lot more interest rate risk when it comes to a syndication based on a commercial asset. When your interest rate goes higher than your cap rate, which means basically the income that you can earn on that asset, your net operating income, when the interest rate is higher than the cap rate, demand falls off for commercial assets. But in single family homes, you're insulated from that because people continue to buy single family homes and pay market value for it.
As usual in this asset class, higher floor.
Higher floor.
Higher floor.
It's just regular old single family rental properties, and everybody wants to go and find something else. I'm like, yo, keeps coming back to right here.
Let's answer a couple of questions real quick, GC. Denny Davis asks, Gregg, any concern about the large amount of investment inventory sitting on the sidelines in Jacksonville? Will the biggies bring their supply of single family homes to market over time to keep the prices stable?
No. So, if you look at the percentage of homes that are actually owned by the large institutions across the country and in Jacksonville, it's still a very low percentage. It's less than 2%. And so there's been a lot of noise made about how investors went in and scooped up all of this inventory over the last few years and how somehow they would be, releasing it to the market and it would crash the market. Just don't see it happening. Number one, the amount that they purchased still hasn't made a dent in the single family home market. Again, less than 2%. And the people who are buying this it's Wall Street who is buying and holding. You're seeing things like build to rent happen, where home builders are partnering with private equity firms to actually build homes, build communities for rentals. Like they put these billions and billions of dollars into this asset class because it wins long term. Yep. And so, no, I don't see that as a big risk. I know other people have made a lot of noise about it, but again, I think that's something that's going to be largely forgotten. Yeah, the biggies, AKA Wall Street, AKA institutional investors, they're not getting into this asset class to flip it. They're getting in this asset class like we are advising you to get into this asset class as a reallocation of their long-term safe part of their allocation, right? Like they're saying, well, instead of bonds, we're going to invest in this stuff, right? Like they're putting their safe part long-term in this because it has a higher floor, it has higher upside than that stuff. Absolutely. Right. So that's what you can do by going to chat with JWB.com. You can be like Wall Street. Last question from Jag at 300 properties. How do you finance the purchases of single family homes? Yeah. So we take on some of that debt that is not, I can't get the best possible rates anymore. I can't get a loan like you can possibly, Jag. If you have less than 10 finance properties on your credit, you're going to get the absolute best rates because I own so many of them. I can't. So we have relationships. We're able to get, very good financing terms for our rental properties that we continue to hold there, but it's not as good as what you're going to get when you buy a JWB rental property from us. And when I was talking to you about how the terms change and it's not as advantageous, I live that. Right. I have to financially plan that I need to pay these loans off in 5 years, in 7 years. And that's what we do here. And, when you own 50 properties in one of these loan portfolios and that needs to be paid off in 5 years or 7 years, take some sophistication to be able to do that. So that's some of the things that we deal with internally that, again, until you reach a level of 20, 30, 50 homes, you don't have to deal with that. It's just simple and easy and the best financial terms, which is what you'll get when you buy a JWB rental property. Good stuff, GC. Great call today. Big Papa, thanks for sending in the info. Yeah, man. The signal that we get is that when the community cares about it and we make a show about it, y'all show up. We had 70 plus people on today. We still got almost 60 people on, over an hour into your workday here. We never, ever, ever take that for granted. So whenever there's a subject that you want to talk about, you send it to us. We're going to talk about it. And GC over here is going to take great care in looking up the data, giving you that data plus perspective. Big takeaways today. Macroeconomics, this idea that there is this home shortage happening, that is something that we've been predicting for a while because you have the data with perspective, right? Like even though sales are going down, the supply of homes is still too low based on the demand. So prices are going up macroeconomically. Zoom into the Jacksonville market. The Jacksonville market is doing particularly well. It's got a particularly low supply
versus demand with a very, very low months of inventory. It's got all these other macroeconomic factors that are feeding the increasing low supply, and an urban core that's about to come online that's going to accelerate the rate of return that you're going to get and the rate of appreciation from all these homes. And then finally, when you compare and contrast that, all real estate is not built the same. The commercial real estate side of it does have a looming crisis because of multiple things. Number one, the underlying asset has changed in its value. The window of time for which people invest in those assets is shorter, and therefore it creates like a change is more variable to your return. And three, the debt mechanism, which is the thing that makes it work, has also completely changed in a short amount of time. While single family rental properties, nothing's really changed except for headlines.
Right.
So those are kind of the big three takeaways. Anything you'd add to that, Juicy?
I think it was wonderful, man. I really appreciate the opportunity. Dad, thanks for sending this to me. I also want to give a shout out to your dad, because your dad sent the commercial debt crisis and syndicators to us a couple of weeks ago. So just an invitation to anybody. If you have something you'd like us to do a deep dive on the show, you can put it here in the chat. You can send an email to info@JWB Companies. You can go onto the Facebook group, which is jwbfacebookgroup.com. Put something there. We do the show for you. And so if you have something you'd like us to discuss, we would love to take you up on that.
All right. Hope you join us on Thursday for the POT dubs, the JWB.
Week.
And it's the last time we get to see each other for a little while this Thursday. So show up, because 4th of July is on a Tuesday. We're going to celebrate the nation's birth. We're not going to have a show next Tuesday.
Mm-hmm.
So we're going to be gone for some time. Hope to see you on Thursday. And until then, do us all a favor.
Don't be average.